Hello, this is Matt Russell from the Daily FX Education team, and what I wanted to discuss today is two separate ways that I apply Elliott wave to my own trading. Now, I'm certainly not an expert in Elliott wave analysis, but there are a few basic concepts that many traders can apply to their trading without being an expert. The first thing I wanted to discuss is the difference between impulsive and corrective moves. And it's something that we can always see very simply in the market. Even looking at it, we don't have to do any advanced Elliott wave techniques to find corrective and impulsive price behavior. In very simple terms, an impulsive price move will cover a great distance and occur in a smaller amount of time, whereas a corrective move will cover less price distance but unfold, if you will, in a longer amount of time. So what does that mean in terms of my trading? Let's say we're right here. We open the chart, it's a Monday morning, we're looking for trade ideas. And I could see that the market has formed sort of a range, so maybe there's a range-bound trade here. But let me zoom out and see if anything preceded it. And lo and behold, I can count 5 waves to the upside just prior to this range forming. So what that tells me is that there's a good chance that this is a corrective move. And the most important thing it gives me is a directional bias, in this case to the upside, because the price trend prior to the formation of the correction was to the upside. So I would be looking for long trades at clear support levels. That's my favorite method of entry. It could be another method of entry for another trader, such as favorable candlestick patterns. The key point is we have a directional bias to the long side. And what we should not do is enter short trades at clear resistance levels for that reason. The second way that I like to apply Elliott wave to my own trading is in terms of basic chart patterns. One of my favorite chart patterns is double bottoms, not because they're very reliable, but because of the favorable risk-to-reward ratios they can generate. So looking at this chart now, I'm looking for a double bottom, and I haven't applied my Elliott wave theory to the chart yet. And a basic tenet of Elliott wave theory is that wave 2 should not exceed the price level where wave 1 started. So let's say we're right here. And I'm looking at the trade, it's setting up nicely, I'm getting excited for a nice double bottom trade, but I'm going to do some extra analysis for added confirmation. And I look back and I can count 5 waves to the upside. 1, 2, 3, 4, 5. So that means that's an impulsive move. And this could be a corrective move, but the key point is here that it's not, in terms of timing, here this was an obvious corrective move. In this case, this is taking the same amount of time that the impulsive move took. And again, things aren't going to be as clean. This is more of a real-life example of what you will see in real-life trading. So again, because the basic tenet that I'm using for my trade, that wave 2 should not exceed the price level where wave 1 started, I have 2 confirmations here. I have a simple chart pattern that I'm using as a confirmation for my entry, as well as a basic tenet of Elliott wave theory. Again, that wave 2 should not exceed the level where wave 1 started. So as prices do come down, as long as I can kind of loosely count a correction, this could be an A wave, this could be a B wave top, and prices right now could be in that C wave, I would look to enter at the level of the first low and place my stop maybe 50 to 75 pips beneath that level. Again, my name is Matt Russell from the Daily FX Education team. Thank you for listening.